Is your home loan going to get cheaper after 9th October? On that day, RBI Governor Shaktikanta Das will have concluded consulting with 5 of his other colleagues on India's Monetary Policy Committee, or the MPC, whose job is to decide once every 2 months if interest rates need to be increased, decreased, or kept where they are. They vote on 2 things. One, the policy repo rate, the rate to which all interest rates in the economy are linked. And 2, something called monetary policy stance, which basically is like switching on the car turn indicator before you're changing lanes. So there is neutral, which means that the RBI can either hike or cut interest rates. There's accommodative, which means that the RBI has the flexibility to cut interest rates anytime, but rate hikes are firmly off the table. And then there is withdrawal of accommodation, the current stance, which means the RBI can hike interest rates further if it wants to, but rate cuts are off the table. So we are currently at an elevated repo rate of 6.5% with withdrawal of accommodation stance. And this has been the case since last year. So every 2 months, the MPC has been meeting and the governor has basically been saying nothing has changed. Inflation is still a problem. It's still above our 4% target. Growth is going strong, and so we have no need to either cut interest rates or change stance. But that begs the question, why is it that markets are so fidgety this time around? Why are they convinced that things could change in the October MPC meeting? And what kind of change are they expecting? Hello and welcome to the Bond Economist, your one-stop destination for professional advice on the economy. My name is Aurodeep Nandi, and today is kind of a follow-up to a video we did some weeks back where we talked at length on India's changing growth inflation dynamics and what it means for monetary policy. And don't worry, you will survive this video without having to refer to that one. If you are interested to get more context about the stuff that we discussed today, feel free to have a look at that video. I'll leave the link at the end. Today's video has a much more nuanced scope. We try to answer what are the different scenarios that could possibly unfold in the October MPC meeting. But first things first, a quick recap on why the market seems to be under the impression that the days of high interest rates could be over. Well, 2 reasons really. First, inflation may be lower than it looks. And 2, growth may be weaker than it looks. Inflation is set to average 4.5% in FY25 according to the RBI, down from 5.4% in FY24 and close to 7% in FY23. So now we have come tantalizingly close to the RBI's target of 4%. Besides, core inflation, which is inflation minus the volatile items like food and fuel, has fallen to multi-year lows. Core inflation is a rough measure of that part of inflation that reflects demand of households. Say tomorrow you suddenly feel rich and you want to buy more pressure cookers. Well, then pressure cooker prices start to go up and it will show up in higher core inflation. So when core inflation is crashing down to some of its lowest levels ever, it basically tells you that the part of inflation that the RBI has the ability to control through interest rates and through controlling growth, well, that's kind of already under control. After all, the RBI can't influence food inflation. It can't control rains. It can't control oil prices. So a lot of people argue that, listen, RBI, your job is done now. Bring down interest rates. So far, the RBI has disagreed. Primarily because it says that its mandate is overall inflation reaching 4%. And that includes not just the price of the pressure cooker, but also the food that goes into it and the cost of heating that pressure cooker. So food, fuel, core. We have to target overall inflation. So even if food inflation is high, too bad. We can't reduce interest rates because what if higher food prices today lead to people expecting higher prices for everything tomorrow? And so high inflation becomes a kind of self-fulfilling cycle. Now, you may agree or disagree with the RBI, but the key point is that inflation is now up for debate. The data is no longer advocating one consistent story of keeping interest rates high. It has instead now become a matter of perspective. Same goes for growth. In the RBI's view, India's growth prospects are stellar. It has forecasted 7.2% for this fiscal year. But most economists are predicting growth to be lower in the 6.5 to 7% range. Why? Well, there are signs that urban consumption momentum is slowing. For instance, car sales are slumping. Dealerships are sitting on an unprecedented level of unsold cars in their warehouses. GST collection in September slumped to a 40-month low growth of 6.5%. So basically, if underlying economic growth is strong, then tax collection should also be healthy. So GST growth ideally should be in line with the 10 to 11% growth that is expected of nominal GDP. 6.5% is actually worrying. Credit growth is falling, especially with the RBI cracking down on banks and financial institutions who were doing huge amounts of personal loans, with Indians binging on fancy phones, stock market speculation, gambling apps, and sometimes credit card loans just to sustain their lifestyle. RBI has been taking a series of steps to make it more difficult for banks and financial institutions to give out these kind of loans. Microfinance institutions that lend to the poorest of customers have been rapped on their knuckles because the RBI realized that people are borrowing from multiple lenders, borrowing from company A to return the money they owe to company B. So RBI's action against such practices is obviously good news for the health of the economy, but regulation naturally carries costs. Credit growth, particularly on the retail side, is slowing down. And so at some level, it is likely to weigh on the economy. Also, much of the investment happening in the economy is still reliant on the government. Private capex recovery has been patchy. And as global growth slows, it may also prove problematic for Indian exports. So be it high inflation or high growth, both have become matters of debate, which makes the current regime of high interest rates debatable too. So given this macro backdrop, when the 6-member Monetary Policy Committee meets on 9th October, which way will they swing? Well, essentially it can go one of four ways. Remember, the MPC votes on two things, the repo rate and the monetary policy stance. So one option is the John Lennon choice. Whisper words of wisdom, let it be. RBI can continue asserting that inflation is still a problem, growth is still fine, and now with Israel and Iran at each other's throats and oil prices zooming up, there's always a risk of higher inflation. So, no change in policy rate and also no change in the withdrawal of accommodation stance. Situation 2, and this is what most economists are expecting. RBI doesn't change policy rates, but it changes stance from withdrawal of accommodation, which means that we can hike interest rates anytime, to neutral, which means that we have the flexibility to hike or cut. Markets will most likely interpret this as a signal that rates could be cut in the coming December policy meeting, when maybe there is further evidence of growth slowing. The problem with this scenario, though, is that Governor Das has generally not been fond of giving forward guidance. When he first took office in February 2019, he cut interest rates in his first meeting, even though the existing stance was that of tightening. Similarly, post-pandemic, when inflation was rising world over and then accelerated even more when the Russia-Ukraine war broke out, Governor Das held an emergency meeting in May 2022 to hike interest rates. Bizarrely, the stance at the time was still kept accommodative. So the stance was saying that the RBI can only cut, but RBI went ahead and delivered a hike. It was corrected to withdrawal of accommodation only in the next meeting. So while people are betting that this time around the RBI will think differently and signal its intention to cut later by changing stance now, the fact remains that RBI has a poor track record of using stance to relay the turns in the interest rate cycle. Which brings us to scenario 3. Here the RBI says, okay, times have changed. The risk of inflation is low. Growth may need some support. We cut interest rates and also change stance from withdrawal of accommodation to neutral, all at one go. This will catch most market participants by surprise, especially because the RBI governor has hardly given any indication in his speeches that he's thinking on these lines. But nevertheless, cometh the hour, cometh the cut. And then there's the fourth option, which is the bizarre one, but can still happen as it had happened when RBI started its rate hike cycle in 2022. RBI cuts policy rates, but still keeps stance at withdrawal of accommodation. And this is going to be strange because why are you cutting interest rates but still maintaining the signal that you won't cut interest rates? So, 4 scenarios. 1, RBI doesn't cut interest rates and also retains stance at withdrawal of accommodation. 2, RBI doesn't cut interest rates but changes stance to neutral to signal that cuts could come sometime in the future if the need arises. Scenario 3, RBI cuts interest rates and changes stance to neutral simultaneously. And then 4, RBI cuts interest rates even as it inexplicably keeps stance at withdrawal of accommodation. Which scenario will actually play out is something that Governor Das will confirm on the morning of 9th October. Until then, like, share and subscribe to The Bond Economist.